Good afternoon, everyone. Welcome to today's webinar by Climate Finance Network Thailand, or CFNT. My name is Amonat Narajin Green, and I am the Outreach Manager at CFNT. I'll be your host. Today's webinar will explore the role of green bonds in driving climate action. We will discuss the global ESG financing landscape, new sustainable finance structures, and key challenges in the sector. Today, we are very honored to have a distinguished guest speaker with us today, Mr. Rahul Sheth. He is the Managing Director of the Debt Capital Markets and Global Head of Sustainable Bonds at Standard Chartered. Before we begin our session, here are a few quick reminders. This session is recorded and will be shared on CFNT's website and social media. However, the presentation slides will not be shared. And if you have any questions at any time during the webinar, please use the Q&A button at the top to ask questions. We will address them afterwards. Without further ado, I would like to warmly welcome and give the floor to Mr. Rahul Sheth.
Thank you, Manat, and pleasure to be speaking with everyone here, and thank you for CFNT to invite me for this forum. Let me try and share my slide deck and get right underway with the presentation. Maybe if someone can give me the share access. Yeah, there you go. Okay, I'm hoping that this is now visible to everyone.
Yes, I can see the screen clearly.
Perfect. Okay, let me just go right up. Okay, so I think the topic for today was, can green bonds accelerate climate action? So this topic is quite close to my heart. Just as a quick introduction, I am with Standard Chartered Bank, and I've been with this bank for about close to 15 years, and all of it in Singapore. I started off the ESG bonds business in 2014, so we just crossed over a decade in terms of doing ESG transactions for our clients across the globe. The work that we predominantly do in this role is we help structure bonds in a ESG compliant manner, i.e. they comply with various regulations, various taxonomies, as we've seen a number of taxonomies that have mushroomed over the last few years. They're compliant under the ICMA's green and social bond principles and sustainability bond principles and guidelines. And also, of late, we've seen other guidelines around transition, around sustainability linked bonds, and so on and so forth. So we try and make them compliant with all of this. And then eventually, the idea being that we can sell these bond transactions to investors whose mandates on their funds allow them, or actually are focused on buying credit which is focused on such ESG labeled debt. I'm sure the audience in that we have today, many of you may have been practitioners yourself in this area. You may have had experience in some situations in working with organizations that have had various ESG level strategy coming in from the top, and maybe in various journeys in terms of their ESG implementation. So what I was proposing to do was to start from with a bit of a background, which might be a bit basic for some of you, but for the rest, for whom this may not be something that you do on a day-to-day basis, it might be helpful to frame the narrative. So I thought what I could do is walk the audience through a quick overview of what are the various types of, when we use the word green bonds loosely, what does that mean, and what are the other types of bonds that are in the same universe as green bonds in the family of what we call ESG bonds. And then we go through in more detail what each of these bonds or these types of bonds, what do they serve, which are the types of companies or which are the types of issuers who issue these kind of bonds, and what purpose they serve. What are some of the challenges that issuers face currently in this environment, especially given, as many of you would have seen, the various announcements, with the regime change in the US. There are a lot of banks who've come out, especially the US banks, who've come out of their various committees and various banking and net zero associations. So what does that climate mean for this broader ESG bond business? And then we'll go through how there's been a lot of innovation over the last couple of years, and where these innovations have helped direct financing to either sovereigns or to corporates where it's genuinely needed very, very urgently. So with that, let me start with the first slide here. Hopefully all of you can see that. So when we look at green bonds, or when we look at essentially what we call ESG bonds, which is the term I will try and use for the rest of this presentation, broadly speaking, we can divide ESG bonds into two main characteristics. One is what we call the use of proceeds bonds, and the second is what we call the KPI linked or the sustainability linked type of bonds. For the first variety, we have three different subcategories. We have green and social bonds, which together form sustainability bonds, and transition bonds. Whereas for the third, it is a separate type of instrument on its own, which is called sustainability linked. So coming to the first three, which is green, social, and transition bonds, the way these work is that the financing. So when a company goes out and issues these bonds, and these bonds are subscribed to by various investors globally, the company commits to using the use of proceeds of that bond in a certain fashion so that it can get a compliance with either a climate friendly outcome, which is green, or a social friendly outcome, which is social, or a sustainability outcome, which could be where you have green and social commitments, or a transition outcome, which is where you are neither green but or brown, but you're investing into assets which are allowing your organization to transition from, if I could use the word, dark brown to a light brown or a green eventual trajectory. So basically, that you're in this interim phase where your asset base is not entirely compliant with green trajectories or taxonomies, but you're in a journey towards moving towards that. So with all of that, what exactly does a green bond do? Essentially, what it does is you have where the financing that you raise is allocated to one or more of about 8 or 9 categories, which under ICMA or ICMA, it has its guidelines on, which is under the green bond principles. So the allocation is made to, for example, categories which could be in the realms of renewable energy, green buildings, low carbon transport. It could be water treatment, waste management, circular economy type projects, and so on and so forth. So there's a fairly well defined set of assets or categories of assets, which, if as a company, if I operate in that sector, then I will have a lot of capex which I can allocate the proceeds to. If I am, for example, a sovereign, and close to us is where we worked with the Thai sovereign, and we've helped with their first sustainability bond framework, where they've issued a few times under. So when we look at that, if you're a sovereign, you have budgetary expenditures which is going and enabling the green industries under the categories that I mentioned. So long as you can direct 100% of your proceeds over a period of time to these projects, then you can call this bond a green bond. When I say 100%, I mean that all the proceeds within a certain period of time, which typically is about 2 years from the time of issuance, must be directed towards one or more of these activities. And when I say directed, I mean either they could be fresh or new investments into which this money is parked, or there could be a situation where the money has already been spent, let's say in the last 3 years, anytime in the last 3 years, and you could allocate it to those projects. So, for example, let's say if I'm in the real estate sector, and I have constructed a building which is under various certifications of, let's say, LEED. It is a platinum LEED building, which is very energy efficient. Um, and if I've constructed and I spent the capex last year on that, and I raise a green bond this year, I can use that green bond to refinance the loans that I might have taken to invest into that capex on the building, and effectively I can allocate it to a refinancing of my existing green assets as opposed to only new financings. This refinancing concept is quite important because it helps issuers who are first time issuers, especially because when they enter the market, because you have a compliance requirement to ensure that 100% of your proceeds are going towards these activities and will be allocated within 2 years, it is always more comforting to go into the market with such commitments when you already have an existing stockpile of assets which you can take benefit of. So let's say many companies, when they do this, they have, let's say, sometimes 70 to 80%, and in some situations even 100% of their assets covered. So they do know that they will never miss that commitment, at least for the first issuance. When it comes to the second or the third or the fourth issuance, then of course there is a lot more pressure on the assets, and you have to create new assets as opposed to depend on past assets. So that's something that we see happening very often with issuers. Now, outside of just allocating it and making the commitment to allocate it to these green assets, what issuers also have to do is to report on these allocations within 12 months of the issuance, so that you are able to go back to the very investors to whom you made that commitment and show them how you're faring vis-a-vis the commitments that you made. So you do have to release what we call an allocation report, and which is compulsory, and also an impact report, which is optional, but most issuers nowadays do release the impact report. The impact report effectively captures what is the impact of the allocations that you've made. So, for example, going back to my earlier example on if I have constructed a green building, there would be energy efficiency. So there would be carbon savings from certain use of certain appliances or materials. There would be water savings because of certain specific building specifications that I might have used, so on and so forth. So we have to list all of that down so that investors then can calculate what is the savings that they have contributed to by their investments into my bond. Moving to social, it functions exactly the same way. The only difference being that the assets that you are directing your proceeds to are social assets. Now, what are social assets? Essentially, assets which are intended to uplift a certain social problem and for a defined target population. By that, what I mean is, for example, there's a situation where when we were looking at the framework for the Thailand sovereign, that was during the pandemic period, and there was a lot of budgetary expenditure that was going towards keeping employment and also healthcare in terms of providing masks, in terms of providing certain specific health-related equipment, which was very critical at that point of time. Outside of that, of course, there were other social programs which relate to education, which relate to providing sanitation, water treatment, not water treatment, I'm sorry, but broader sanitation issues. There could be issues around affordable housing. So you're providing your population with people who are living, let's say, below a certain minimum level of income thresholds, they are provided with a housing program which allows them to afford such houses. So like that, there is, like you have for green, you also have for social a number of set and defined categories of projects which you can allocate the proceeds to. For social, obviously, it is sometimes viewed to be a little less tangible than green because green is very well defined. There are a lot of taxonomies also that are applicable to green, which like the European taxonomy, which is probably one of the most robust taxonomies where very clear-cut thresholds are defined. Let's say for renewable energy, there's a threshold that the emissions cannot exceed 100 grams. For hydropower, you have further requirements that there's a power density factor which becomes applicable. Likewise, for zero emission vehicles, the tailpipe emissions, there's a threshold, so on and so forth. But when it comes to social, it is somewhat dependent on the issuer and the region and the country in which you're operating, because not all social housing programs or employment generation programs will be exactly identical in terms of thresholds. So there is a bit of, I would say, personalization to social. So to make it very impactful, the requirement is really to ensure that the target population is very, very clearly defined, and so that you can calculate the impact that you're making. When a bond is allocated both to green and social assets, which is typically now, I would say most issuers or many issuers, I would say, they do allocate in their balance sheet may have green as a pivot, but social assets also exist. So let's say 70 to 80% goes to green and 20 to 30% goes to social. Whereas there might be certain others where, especially in sovereigns, a lot more may be going towards social programs, a lot less to green. But basically, the idea of combining the impact with green and social projects allows you to call the bond a sustainability bond. Now, within green and social, over time, many investors have developed what we call sub-themes or requirement of sub-themes. So, for example, within green, we've also developed a concept of blue bonds, which are, I would say, still a bit nascent at this stage, but we have seen quite a few issuances in the pipe. Where blue bonds, and I'll go through this in a bit more detail in the subsequent slides, but essentially what blue bonds does is that it directs the proceeds specifically to SDG 14 related activities, where you're focusing a lot more on the coastal regions where you can direct money to certain specific activities which could relate to cleaning the coastal areas, protecting the flora and fauna in these areas. In some situations, even floating solar can count towards blue, so on and so forth. Likewise, in the social category, we see gender-related bonds becoming a little more topical. Again, investors have shown interest to focus a lot of investments into gender-related activities. So let's say if you were financing an SME or a micro SME institution, but that one and if that SME has is funded by or is run by certain specific people or genders, a lot of it run by, let's say, women-based SMEs, that has typically what we've seen is a lot of investors have preferred that level of segregation, and we've seen a lot more demand in that asset class. And that's why what we have now is an orange bond, which is a separate class of an asset on its own within the broader social umbrella. Moving on to transition very quickly. Transition bonds are, again, another use of proceeds category, but essentially the assets that you're allocating to are not green or social specifically. They are asset categories which are allowing the entity in who's issuing to move from a dark brown or brown to a green outcome. So, for example, let's say where in a situation in Hong Kong where we looked at a utility, an electricity utility that converted its coal-fired generation into gas-fired generation, with the idea that eventually they would go into hydrogen-based generation. That was the transition that they were making, and the capex that they were spending was effectively construed to be a transition bond. And finally, when you see sustainability linked bonds, this moves away completely from use of proceeds. So which basically these are bonds that are designed to achieve a certain specific KPI in mind, and that KPI could be a climate KPI or could even be a social KPI. Proud to again mention that we've been involved with the Kingdom of Thailand, which structured its first and issued under its first sustainability linked format end of last year. Now, in this kind of transaction, as you would have guessed, there is no restriction on where you're actually spending the money, but you do have to ensure that the money is spent in such a way that you are achieving a certain specific outcome. So for the Kingdom of Thailand, for example, we designed two KPIs. One of it was on the GHG emissions reduction KPI. So there's a commitment to reduce a certain amount of or a certain percentage of emissions by a certain date, let's say 2030. And we also used another KPI, which was in relation to the electric vehicles registered in the economy, because as we see, transportation has a very high percentage in terms of the total emissions for the country. So we did use that also as a percentage increase in the quantum of such vehicles would contribute, in our view, to the broader climate agenda. So if you do meet those objectives, then in some situations, like we have for the Thai issuers, there is a step down in the coupon rate of the bond. If you don't meet those, then there could be a step up in the coupon rate of the bond. So that is the way these are designed. So there's no specific requirement on use of proceeds, but there are gains or penalties on achievement or non-achievement of the targets. Now, why we needed the sustainability linked issuances is, and how they contribute is, a lot of issuers are not green by definition, which means that they are not in a position to issue green bonds because they could be, let's say utility companies or oil and gas companies, but they are making a lot of investments and strides to move into greener sectors with renewable energy as a base. But having said that, they can't issue green bonds. So we realized, and the market realized, that for the longest time, they were not being able to raise such kind of financing, and were not getting enough dollars in to be able to raise such kind of financing because there was no suitable label. With the transition label and the sustainability link label, which was introduced a lot later in the process, a lot of these corporates were able to utilize ESG labeled bond transactions and then direct them to the specific capex that was required. So with that as a backdrop, I know I spent a little more time on that, but I think that'll set the tone for the next few slides, which I can then run through a little more speedily. So what we wanted to also do is give a context of, you've seen what are the instruments. We wanted to see which are the instruments that are that have been used globally and also in Asia. If you look at the chart on the left, top left, that is the total ESG bond issuance in billions of dollars. You'll see in 2021, we had the biggest year where we hit $1 trillion in ESG bonds. And this is across the full suite of full umbrella of ESG bonds. That was, again, one of the biggest years in the debt capital markets globally. Having said that, after that, we did see a bit of a slump over the last couple of years. That was not really to do with green agenda being lost or going down. It was actually to do with the fact that interest rate volatility caused certain investors to stay away from the market, and effectively issuers also stayed away from the market for some similar reasons. And we also saw certain specific geographies, including in Asia, where there was a huge amount of issuances in the previous years. There was certain concerns, and people issued a lot lesser. But having said that, in 2024, we've almost touched the 1 trillion mark again. So the good thing is over the last 3 years, as you can see, it has been on the rise again. And this is despite the challenges that we are facing, as I said, with some of the US counterparts, who have pulled out of certain agreements, and there's a, given the US is looking to come out of the Paris Agreement. So all of that notwithstanding, I think it has been quite a big year. It shows that ESG is back in terms of volumes. If you look at the chart on the top right, that is just a breakdown of what is the percentage of sustainability linked versus green versus sustainability bonds versus social bonds. As you'll see, for the longest time, the blue bar on the bottom, for the longest time, that was the green bonds was the biggest in the market. For the longest time, that was the only product in the market. Once the pandemic started, social bonds became a big theme because, as I said, a lot of governments were funding social projects during the pandemic. And now what we've seen is that it's a good mix of green, social, and sustainability bonds that are big. The SLB market, since I'm covering some of the challenges, what happened was that the SLB market, while it grew to about 10% of the market in 2021, over the last couple of years, we have seen some regulatory changes and certain, especially in Europe, where the regulators have found some of the SLBs to not have been structured as ambitiously, which means that the targets that have been set have not been very, very ambitious or very, very critical or core. And there's been a lot of crackdown and scrutiny on the product, and which is why many issuers have tried to stay away from that product or have moved into the standard use of proceeds products. So we do believe that in any developed market that is developing, it is first important to allow issuers to go out, explore the product, issue. People will make mistakes, and then when the regulations come in, then it allows the market to settle in eventually into what we call a highly transparent and a highly robust market where there's enough guardrails in place, but there's also enough experience by then to be able to go out and sort of put your name out there for an issuance. One of the slides on the bottom, I'll just quickly cover that off. As I mentioned, why this is in Asia, what we do also calculate is the ESG share, i.e. of the total bonds that are issued. Not all are ESG, some of them are conventional. What we saw is that the percentage of ESG bonds in Asia has significantly risen. So in up to 2020, it was about 8%, but then in 2021, it was a breakout year. It went up almost 3 times in terms of percentage, and then it went up further in 2022 and 2023. Over the last 2 years, we've seen a percentage decline, but that is also a function of the fact that the overall volumes went up in terms of the denominator. So it's not specifically that the ESG volumes went down, but it's the percentage went down of a higher base. So we do keep a track of that to see how ESG bonds are tracking versus the rest of the bond universe. But I think I have one eye on the clock, so maybe a lot of this has been covered. So I'll move on to a couple of other slides on the thematics, which I think are more important. As I mentioned, the blue theme has caught on. It has become a critical part. Blue is, whenever you're thinking of blue, you think of water, you think of oceans, you think of coastal regions. The good part is when you solve for blue, you're solving for a climate related activity, but there are other benefits in terms of social, because typically many of these are directed towards projects which do provide employment in many of the coastal regions where a lot of the target population may be living below a minimum threshold. So therefore, it does come in typically with a lot of employment related benefits and social benefits. The blue theme, one of the biggest challenges that we've seen with the blue theme is, and why it has still not been as big as the green counterparts, is firstly, many of the private sector issuers, they may or may not have direct linkage with oceans, with the ocean economy or with the maritime economy, right? So it is a lot of times it is with the governments or it is with quasi-government kind of institutions. Not saying that the private sector hasn't issued; they have issued and they have issued in some situations in benchmark numbers, but it's a problem of accumulating enough assets to be able to do a public bond. And by public bond, I mean typically public bonds are north of $300 million. So $300 million to $1 billion is typically what you see as size. And sovereigns, be it Thailand, be it Indonesia, be it Philippines, they have all issued in the ESG markets and in big numbers. So sometimes what happens is, given that you have the requirement to allocate 100% of the projects and proceeds to these activities, it sometimes is difficult to accumulate enough assets in the blue only economy to be able to issue a full benchmark transaction, which has sort of been one of the reasons why the issuance volumes are typically smaller. Some of the, Indonesia has been an issuer in this market. We've also seen the Nordic Investment Bank, the World Bank, ADB, and issuers from Korea, and Thailand issue in blue formats. So therefore, this is quite a theme, but it's one that still needs a little bit more work to be able to catch up with other counterparts. This is just a quick overview of what we collected. When you see the Thailand Budget Bureau papers and especially in relation to the marine and coastal resources, we do see that there are certain programs in the marine economy and also in relation to water where this concept moves pretty quickly or works pretty well with the blue thematic. Gender-based financing is also what I touched on, which are what we call, there's a new badge or label which is called orange bonds, which again is part of social, but essentially it has got a lot of impetus where the focus is on either investing into something which is a business that is run by, for example, women, or which is a business that is benefiting a particular gender, and then there is adequate amount of reporting and transparency on that. So these are some of the three principles of the orange bond concept. We have seen a lot of investors, global fund managers like Nuveen, MetLife, Pathfinder, Impacts, and so on, who have invested into a number of social impact bonds where there's a direct linkage to funding microfinance institutions and SMEs who are either run by women or are benefiting women in a big way. The Women's Livelihood Bond Series, which you'll see on this page, I know the font size will be a slightly smaller, but essentially this is what we call the WLB series. Sanchart again has been very proudly associated with 5 or 6 iterations of the WLB bonds, and these are bond transactions which is a perfect blend of blended finance which helps fund the target population, which is the women-based microfinance institutions, where in these kind of, this is like a typical a synthetic asset-backed or a CLO structure, where you get a first loss piece covered or the equity piece covered by an institution, like let's say excuse me, there are certain institutions like, for example, the Rockefeller Foundation. It could be certain other institutions who would like to support this kind of initiative, and on top of that, there's certain partial guarantees that are provided, for example, by institutions like the DFC and certain other catalytic partners. So this allows you to raise financing, and over time, what started off as an $8 million issuance size has now, in the last iteration, moved to about $100 million in size. This allows significant amount of funding to go to specific businesses which are benefiting women. And the good thing about this is to qualify under the orange bond label, there is a lot of transparency that is afforded. So there's live interviews that is conducted, there's live surveys that is conducted from the end beneficiaries to showcase that there is the impact portion that is covered. I mean, there's enough impact that is being generated out of these bond transactions. So again, the birth of these social impact bonds, similar to green, have helped direct financing to exactly where it's needed. And this, even though some of these volumes may be small, but the impact is sometimes even larger than some of the institutional transactions that you see. I think maybe one more type of transaction I would like to cover before we open it up to Q&A is what we call the outcome bonds. Outcome bonds are again a type of a blended finance institution, a blended finance initiative. By blended finance, again, I mean where institutions like the multilateral development banks, the DFIs, they provide either some sort of support or guarantees, or they act as a shield to provide a principal protected issuance to investors to support these kind of transactions. And this allows small developers who ordinarily may not have gotten funding to get funding, firstly, and get it at very compelling rates and transactions that support the businesses, which typically generate revenues at a later stage. I mean, some of these transactions need capex for the first 2 to 3 years before they can start generating revenues from the third or the fourth year, which normally would not be funded by banks, or would not, may have to rely on small amount of equity funding that they can get. But this kind of bond funding allows bringing various parties together to support certain specific causes. So I'll take conceptually speaking, how these outcome bonds work is you have and mostly it's been the World Bank that has been mostly involved in these. So I'll just talk about one or two of these cases. The one on the right you see, which is called the emissions reduction linked notes, was one that was done in Vietnam, where the World Bank issued a bond of about 50 million, and about 7 million of that was then on loaned to a project developer, which was actually making water purifiers available to certain schools. Water purifiers allow you to, the way it functions is it generates carbon credits, because the other alternative forms of clean water availability involve certain methods which are highly carbon intensive. So given water purifiers are not carbon intensive, this allows you to generate certain carbon credits. We have an off-taker of these carbon credits who effectively then pays the World Bank the value of these carbon credits, and the World Bank uses that to fund the interest part of the interest component on the bond transaction. So investors who are buying into this are buying into a bit of a transaction which gives them some amount of fixed return, but a good portion of that is a variable return of interest, which is completely dependent on the project, because it may so happen that the projects may get delayed in implementation, or carbon credits may or may not get generated, or the adequate amount or the targeted amount of water purifiers may or may not get produced. So there might be a slightly different amount of interest that might come in, but the off-taker effectively off-takes what's coming in, and eventually the investor takes some of the risk on the coupon. But as I said, the World Bank comes in to issue the bond transaction, which means that the principal is guaranteed, i.e. after 5 years or 7 years or whatever is the tenor of the transaction, you do at least know that you're going to get back your principal and a certain minimum amount of return. But there is a certain percentage of return which some of these funds are obviously going to take some risk on the project. And the reason they can do that is, again, that their funds allow them to take these specific risks, because they do feel that their funding is catalytic in nature, and it is allowing project developers like these who otherwise may or may not have been able to function or create these businesses. We've seen a similar situation with the deal on the left side, which is called a Rhino bond, which is a social outcome bond. It functions almost identically, but essentially what happens is, instead of so here you're creating an environment to protect the rhino rhinos and effectively based on the population of rhinos, if the population goes up and meets certain threshold, then there is a donor fund, which in this case was the Green Environment Facility, which comes in and makes the payment like an off-taker would have made in the case of carbon credits. So essentially, it is somewhat similar in concept, but these kind of transactions are allowing, again, directing financing to where it's needed the most. So with that, and we have seen many more of these transactions come in. We've seen a lot more investors coming in and participating. So it's actually creating a good ecosystem for moving out of the traditional green and social bond universe to these kind of transactions, which may not be labeled transactions, but actually are in substance providing a lot more direct financing. So with that, let me take a pause and open it up for Q&A.
Thank you very much for your invaluable insight. So right now for the audience, if you have any questions, please feel free to click the button for the Q&A, and then I will read the question aloud for Mr. Rahul. For now, I have one question from our researcher about the recent one that you just presented about the rhino bond. We wonder if the rhino bond model can be replicated for other endangered species or ecosystem restoration projects, and what modifications might be necessary.
Sure. So if it is the other endangered species, yes, definitely we do know of certain projects that are already underway to protect endangered species. So in a sense, the structure remains almost identical. I mean, there could be two ways to do this. One is the rhino bond structure where you have a donor fund coming in, which is um, providing you the variable coupon amount to the extent that you're able to meet certain KPIs. And if you don't meet those KPIs, which essentially relate to the habitat improvement and the increase in the species count, if you don't make those, then the variable coupon is not made. So that is the way it would typically work. One adjustment that you could make to this kind of structure is that if you don't get a donor fund, in some situations we see park operators, like where you have certain specific parks that are meant for certain endangered species. There you could have a tourism operator operating, and the tourism operator could be spending the money developing the park, but also could be off taking the ticket sales of this tourism attraction. And based on the number of people who are coming in and buying these tickets, that could help pay the coupon cost. So there's various models that you could use, and the two models are effectively, if you look at it, it's either a donor fund or it's a private sector entity which is actually off taking a commercial outcome. But in both situations, it is all dependent on the increase in the KPIs are similar, i.e., the endangered species habitat improvement as well as count improvement.
Thank you very much. For the next question, which type of bonds would take the least time to issue between social, green, and other types?
Yeah, sure. So I think the way to look at this from a timing perspective is to do something which is coming very naturally to an issuer. And by that, what I mean is, if let's say your business is doing investment in solar projects or wind projects, the easiest to do is to do a use of proceeds green bond, because by definition, most of the work is already done, because it is a very simple asset class, which is investment into renewables. And you could get the green framework and the second party opinion and reviews, all of that done in a very, very quick manner. It could take even sometimes even less than a month if a lot of the assets are in a pure dark green format. If you are, let's say, if you don't have an obvious category of assets that you're investing in, but at an organization level, you have already set certain KPIs and very stringent KPIs which are aligned to certain international trajectories, um, which which allow you effectively, which determine the strategy of the organization to move investments into areas that allow you to meet that KPI in the next 5 or 10 years. If you already have that in the organization, then my suggestion is doing a sustainability linked bond would be probably a little easier because again, all of this is already approved by the board and at the management level. So the acceptance and the agility of achieving the outcome is going to be much greater.
Thank you so much. We have the next question. Kun Pichayapong wonder, what are the biggest benefits for companies that issue green bonds? Does corporate get premium for issuing green bond according to your findings?
Yeah, no, a very, very good question. So the way we're looking at green bonds is there could be certain times where you could be getting a greenium, and that depends on market conditions at the point of time, as well as what is the percentage of dark green funds that are coming into the bond. So if you have a very high proportion of that, many of these dark green funds are buy and hold investors, and by that what I mean is that they unlike hedge funds who would typically sell down immediately for a quick gain. These investors are more prone to holding your bonds because they like the climate related aspects or the social related aspects of your bond. So in that they will be more aligned to even a tighter pricing because they like the ESG credentials, and they may not be able to get another bond with the same ESG credentials, right, as yours. So with that, typically in some transactions we've seen 5 basis points price tightening, or in some slightly even more. But in many transactions, we have not seen a price tightening, or we have not, they have effectively priced at par with the existing bonds. But what we've noticed is that the investor outcome sometimes is different, which means that you have some new accounts or new investors who are coming in because of the ESG credentials, which would not have come in because it was conventional. And in some situations, you have the same accounts who are putting in larger orders because they have other sub funds that can buy for ESG and some funds that can buy only for credit. So therefore, you see more from same or sometimes new accounts, and that allows you to diversify your book a little bit more, even if sometimes you don't get a pricing advantage.
Thank you so much. That was very clear. We have more question coming in. How can investors be sure that the funds from green bonds are actually used for green projects?
Yeah. So at the issuer or the borrower level, there is what we call an annual reporting that has to be done, which is mandatory, and that is what the borrower will commit to when raising the bond. So that allows you to get access, and this is available on the website. So it allows you to get access as an investor to the allocation report, i.e., how much has been allocated to which set of projects and what is the impact of that. And if, let's say, the allocation report is not produced or is delayed, or if, let's say, the it's produced but the allocations are not, up to the liking of the investors, they can always have a direct conversation with with the borrower. In some situations, we've also seen where, um, let's say, the borrower, when they borrowed or they issued the bond, they had a view that the asset would grow at a certain pace or they would get new projects. But that doesn't sometimes materialize. So you could see that some of these investors may actually sell down these bonds because it's no longer meeting the ESG commitments. So the reporting, annual reporting, and transparency around that reporting is important. In most situations, the borrowers also get a independent third-party review on that report.
That's very interesting. Thank you so much. We have more questions coming in. What happens if a company fails to use the funds for the promised green projects?
Sure. So what happens is really, legally speaking, nothing happens. By that, what I mean is that we do not have events of default tied to ESG commitments. So let's say in the example that I took, if the idea was that there was a new plant that was going to be invested into that was generating a specific ESG outcome, and that plant, for example, gets cancelled, then it's very difficult for the issuer to then remain allocated for the full value of the bond, which means the moment investors hear about that, the only option that is available to them is to either sell the bonds or come out of the bonds, or to put it into another fund, which is a non-ESG fund. Uh, so the way the markets function in this space is it's a best efforts market. But if you do not meet your commitments, while there is no legal recourse for investors, there is obviously it's a reputational damage to the issuer. And it'll become almost impossible for the issuer to come back to this market and say, well, I'm going to do another green bond, and this time I promise to meet my commitments. What we have in the offering circulars is risk factors which cover the fact that there could be change in plans or there could be unforeseen circumstances within which the issuer may or may not be able to comply with the ESG commitments. So the investors who are buying this are fully aware of these risks. But of course, we see that as an exception than the rule. An overwhelmingly large majority of issuers meet their commitments, and as I alluded to in the beginning, most issuers who go out into the market, especially in the debut nature, typically go with a lot of existing assets already in their stockpile so that they don't miss their commitments.
Thank you so much. Now we have two more questions. First, for the investor side, have you found a certain evidence in what aspects green bond outperform the traditional one? Apologies, Mr. Rahul.
Oh, sorry. I think I
Please
was
unmute the microphone.
sorry.
Thank you.
I realized I was speaking to myself. Sorry. So what I was saying was that so there is no thumb rule that ESG bonds will always perform better than non-ESG bonds. You expect them to perform better for the simple reason that investors in ESG bonds include the standard credit investors who would have invested into the conventional bond, but it also includes green investors who are additional. So by definition, it should perform equal to or better than. But sometimes there's a lot of other factors depending on where it priced, what is how is the treasury curve moving, how close a maturity is it versus the other bonds, and sometimes treasury moves in near-term bonds may be more volatile than longer-term bonds, so on and so forth. So there's a lot of other factors that go into the trading performance, but leaving that aside, ideally green bonds should perform at par with or slightly better than, because bulk of these investors, the make of these investors is more buy and hold. So in volatile periods, especially, you should see more differential, i.e. ESG bonds should perform slightly better. But again, it is, with when you look at 100 issuers who've issued, and you compare the curves, it's almost impossible to find that there's a clear sort of winner, i.e., let's say 95% of the times there's only one bond performing better, because as I said, there could be a situation where there's other dynamics in terms of pricing, in terms of the tenors, etc., that could outweigh the green aspects.
Thank you so much for your answer. Now we have one more question. So please, the audience, if you have any other questions, please click the Q&A button and ask your question very soon. Otherwise, after this question, we will start to wrap up the session. We have a question from Clinton. What advice would you give to smaller local governments or organizations with few resources that would like to increase their green financial literacy and or partner with banks like yourself to access climate finance?
Sure. So I think there is obviously there's been a lot of progress in this space, and there's a lot of literature available in terms of upskilling on how the markets operate, what kind of assets are seen more positively by investors, how should issuers regroup their priorities within the SDGs, how should strategy be reorganized to align with investments into these sectors, so there's an appropriate decarbonization journey that is in motion. A lot of all of that is very well documented in when you pick up, for example, any in this case you're looking at sub-sovereigns, but if you look at other sub-sovereigns, or if you look at the broader private sector also, you'll see a lot of that material. But happy for Standard Chartered to also provide some sort of training sessions, as we can always have these conversations. As I mentioned, we have worked with the government very, very closely on both their ESG frameworks, one on the use of proceeds, one on the SLB side of things. But I do feel that there are other institutions like ICMA, as I mentioned, who do offer these courses also, there is, I would say, a lot of learned experience now in the industry over the last decade, for a lot of training material, for anyone who wants it.
Thank you so much. I'm checking in, and right now there's no more question. So before we go to the closing session, I would like to thank you, Mr. Rahul, for all the insightful information, including different ESG levels such as green, blue, and orange bond, rhino bonds, and emission reduction linked notes, growth of the global and regional ESG bond market, and as well as the real-life case studies and their practicalities, also from the Q&A session. Now, I would like to share about our next webinar. So for our next CFNT webinar series, we have also a very interesting topic, which is about phasing out coal case studies from Germany and the Philippines. The session will be provided on Thursday, April 3rd, and the language will be in Thai. To stay tuned, updated on the CFNT information, you could visit our website, Climate Finance Thai, and then subscribe to our channel. You can also connect with us on different social media such as Facebook, LinkedIn, and YouTube. Also, we also have the membership. So for the CFNT membership, you will get the exclusive benefit from us, such as stay updated on CFNT activity, be the first to join our session and activities. So for CFNT member, these are some examples that we have the activity earlier last year. We focus on engaging talk and events. If you're interested in joining us, you could go to our website and apply for it through the membership section. Today, we would like to ask you for the webinar feedback. Please scan this QR code. It will only take about 1 to 2 minutes.